All right, great. Thank you, Marty, for setting this up. So my name is Bobby Solar. I work for a firm called Strategies for Wealth. We're a full-service financial advisory firm. Our niche has always been with the business owner. So we help business owners as they're starting their company, as they're growing, they're have some good cash flow, going through some tax saving strategies. Maybe we're helping them take cash out of the business and do other things, being smart about it from the estate planning aspect. And then we're helping them when they grow and potentially sell that sell that company, liquidate it, what they're going to do with their funds, how they're going to set up their family and next generation. But this panel is not about me. This panel is about alternative strategies. And I have two great people sitting next to me. We have Mauro over here, and we'll go around the room and hopefully they can introduce themselves, give you a little introduction on who they are and while they're in the alternative space. And then I have some questions for them. So start with Suzanne.
Sure. I'm Suzanne Murphy, based here in New York, and I sort of wear a couple of hats. I was a partner at a hedge fund that we sold in 2010, which was a liquidity event for me, and I created my own family office. While we look at a lot of things ourselves, we also work with an outsourced CIO based in LA called ICG Advisors. Jeff Asaph runs that business. He was my smartest client at the hedge fund. And I can tell you, I enjoyed being his client more than I enjoyed him being mine. And I also work with a family office that made their wealth in the money management business, in the lower middle market event driven space. And they stepped away from the market in 2013 because they didn't think the environment was particularly robust for what they do. That has changed with interest rates backing up. And so we're looking to raise a new fund, and we can talk about that too.
Sounds great.
Hi, Brian O'Neill, retired earlier this year as the Chief Investment Officer of the Robert Wood Johnson Foundation after 20 years there. And, you know, foundation investment portfolios tend to be equity oriented, but there's also some room for uncorrelated investments. And before the financial crisis, bonds filled a big part of that role. But since the financial crisis, you had to look elsewhere. So we did quite a bit of investing in the alternative space, as Marty described it. Before joining the Robert Wood Johnson Foundation, I spent 22 years at the Equitable. I hate changing jobs. And I was the Chief Investment Officer there when we went public, and then was fortunate enough to spend 3 years working with AXA in Paris.
And I should have mentioned, in the family office, we're totally focused on alternatives. We don't do any traditional investing per se. It's, you know, I get sadly 40 K1s a year, as my accountant constantly complains.
Mauro?
Thank you for the slide. Here is Mauro Andriotto. I'm based in Switzerland. I'm an adjunct professor in finance in Switzerland and Italy. I'm part of a family office that is based here in Switzerland. We are present in 15 physical locations around the world, from China to South America, and clearly in Europe and Switzerland. I am into venture capital as an advisor. I've been working with the European Commission since 2014 as a jury member of the European Innovation Council, where I've helped the European Commission to select companies in the program Horizon Europe, that is a 95 billion program of the European Commission. Right now, I have a similar position with the Swiss Federal Agency for Investment in Swiss. And as a family office, we run a different type of investment, both in traditional finance, but right now I'm following several deals in the alternative sector. So we are in luxury real estate, cryptos, tokenization of commodities, gold, diamonds, and I will be happy to describe them a little bit more later. Thank you.
Thank you. So why don't we start off with a question, just the three of you will go around, just what you're focusing on today, what you're seeing in this environment, what you're excited about ending 2023 and going into 2024.
Okay, well, it's going to sound like the latest fad, but I will say private credit. And a couple of reasons for that, although it is getting a lot of attention at the moment. If you look at what's happening in the banking system, the banks are becoming less and less important providers of credit to the economy. private credit is stepping in to fill that void, really. And it started after the financial crisis with Dodd-Frank, which particularly really cut back on real estate lending, and you got a lot of real estate lenders being created, and now it's very broad-based. And I think the thing that's interesting is with the rise in interest rates, there's been a lot of movement in terms of relative value across kind of the capital stack. And no one's really sure how much senior debt should pay, how much middle debt should pay. And so I think there's a lot of opportunities to find good managers and earn some very attractive returns as companies adjust to much higher interest rates.
Yeah, I'm going to add to that. I would have said the same thing. I do think this is going to be a very good vintage for private credit. I think to your point that the banks are not lending, and for smaller companies, the regional banks, the traditional lenders of choice, are really hamstrung. That's one of the reasons why we're looking to relaunch this fund, because we focus on companies that have $7 billion of enterprise value, what we would call the have-nots, that don't have access to capital and that have over-levered balance sheets because money was free.
Right.
And so that's, I wouldn't have gone to work with these guys if I didn't think that was a really good opportunity. I would also add, I think there's also going to be opportunity in people who can work out the prior vintages of private credit, because private credit was a little bit of the Wild West. It has been very much in vogue. There has been a lot issued over the last number of years that's not going to do so well, either because it's been underwritten poorly, or just because of the nature of the beast and where interest rates have gone. And the traditional, and I'm not talking about the Ares of the world to do a fabulous job, I'm talking about more the marginal players who probably haven't underwritten these things as well as they could have, and they certainly don't know how to work it out. So there's going to be opportunities for people who can come in and have those skills. And so those are areas we're looking at pretty heavily. And we also remain incredibly interested in healthcare, because it's just not cyclical, and the demographics have such a tailwind at their back. And so we're invested in healthcare, both from a public markets perspective and a private markets perspective. And then the last thing I would add is certainly, and here, due diligence is really going to be key in terms of who you pick in their expertise, but workouts in the real estate sector.
You think there's a breaking point for the higher interest that have come through and companies really starting to feel it as they might have that's coming due? Do you think we're close to a breaking point, or do you think that these the majority of companies that can handle these higher interest rates?
A lot of companies' coverage ratios have changed quite dramatically. There isn't a specific maturity wall that's going to get hit. So our view is this is going to be a drawn out, it's not going to be a falling knife trade of 2008 or 2015 or COVID. The government is not going to be able to come in if there is that kind of a crisis and inject, this is our view, inject the kind of capital they have in the past, because they've seen the problems that's caused with inflation and other things. So we believe this is going to be sort of a Chinese water torture drawn out cycle. Again, particularly for the smaller companies that don't get the attention. The oak trees and the canyons and the Apollos of this world, and Blackstone, whoever else you want to mention, that are the sort of the big mega guys, are sitting on a lot of money to do these larger deals. But what they will also tell you, there was a panel at the iConnections conference last year, which was John Zito from Apollo, Mike Arrighetti from Ares, Mark Lazary and Josh Friedman from Avenue, and Josh Friedman from Canyon. And they were all sitting up there going, yeah, we're all in a food fight against each other. We know we're going to overpay, but we're sitting on all this cash. We have to put it back to work. The returns will be okay, but we're going to pay more because I'm going to fight with Mark, or I'm going to fight with Michael, or I'm going to fight, because there's only so many big deals. And in order to move the needle on those big pools of capital, and that's a big complaint that investors have. I'm sure you hear this, Brian, that, all this money's been raised and it's not been put to work.
Well, and not only that, but in a way, those were the good old days, because right now the LBO community is kind of sitting on their hands. The cost of financing a company has gone up. The prices of those companies haven't come down. So they're sitting and waiting. And so right now, in a sense, private credit would appreciate there being a few more deals and a little more activity, because money is kind of piling into that space. But I think the distressed opportunity is very real. The only thing is there's also a lot of money that's interested in that.
That's why we like the smaller space, because there's less people chasing it. But you're right, there is a lot of money. But I think to your point also, and then we should let Mauro get in here, but The other place that I think there's going to be really interesting opportunities in secondaries and private equity, because a lot of people like I don't know what the Robert Wood Johnson Foundation, but I talked to the CIOs of endowments and foundations, and the denominator effect is just devastating, right? Because the equity market, the public markets have not come down as much as one would have thought. And yet the private equity, but they've come down, but the private equity has not been marked. And these endowments and foundations have to still pay out their 5% a year or whatever their mandate is. So the CIO is sitting there going, the accountants marked me at $1 billion at fiscal year end, but I know I'm not really $1 billion. So I'm really 900 million, but I got to pay out 5% on $1 billion. And so there's definitely going to be opportunity as people try to right size those allocations, I think.
Absolutely. Let's give Mauro a chance. And
Yeah,
I'll tell
Mauro,
you what it's like.
What are you excited for 2024?
Well, absolutely. I see there are some opportunities in the private equity sector. We have some deals we are looking at. Above all, because some of the past deals have been stopped because for the problem of being able to finance the deal. We have some opportunity now. We believe that multiples will come down a little bit. And this will open some good opportunities for good companies that we may acquire. I also believe that interest rate will have to come down a little bit, as I see that there is the beginning of some tension in the real estate market. And in the past, the last big crisis we had started everything from the real estate, so from subprime crisis. I'm a little bit concerned because I see that the equity market is not very concerned about the situation. So I believe that we should stay prudent about the future and the investment in the public market. Another interesting area, I believe, is the crypto market, even if in the last 2 years, the level of correlation with the public market has increased a lot. But I see some opportunity there because if the cryptos will behave as in the last 12 years, we should expect very soon a bull run in the next 12-18 months.
It's great. And you were mentioning to me on the phone yesterday that you have some interesting technology that you're investing in to take advantage of that. Do you mind just elaborating a little bit on that?
We have a platform that is authorized in Switzerland to tokenize and create financial contracts that are going to be registered on the blockchain. So we are looking at a different type of assets that are going to be tokenized. One recent project that we have closed is in the north of Italy, in the second most famous ski resort, and it's not by chance that we have decided to take a project in the luxury real estate sector, as here we have a very low correlation with the interest rate. Most of the clients that bought the apartments, they did not require a mortgage. So that I would say, from a commercial point of view, was a very successful deal. We have already sold 11 apartments on a total of 15 in less than 9 months, and we have sold them on papers, making a total profit of around 2 million euro. What we have done, actually, we have tokenized this apartment. We have tokenized the investment of this apartment. That means we have tokenized the shares of the holding company that is in Switzerland, that is controlling the Italian vehicle that is running the deal. Another interesting area where we are looking to create a financial contract is in the energy sector. In Europe, the cost of energy is very, very high, above all after the Ukraine crisis. So we are trying to understand if we can match somehow the cash flows from photovoltaic plants that we have or that our clients have, with the outflows that user and companies support in cost to pay the bill for the energy. And this is something that we would like to tokenize, because this allow the possibility of a fractionalized investment. So you would be able to make an investment in a big photovoltaic plant with 100 euro. And above all, we can provide a secondary market. So it would be like a kind of a secondary market of energy real estate, but we have also other assets that we are trying to tokenize, as for example, gold, diamond, and also maybe we are thinking at something in crypto mining, as we believe that there will be a bull run for the crypto market. And with mining, from the last analysis that we have done, we would have been profitable till the price of $20K to $20,000 for the Bitcoin. That means it would have been a very good investment, even in the worst moment of the market.
That's great. Thank you. So for you two, have you been, are you excited about the energy sector like you shared, or potentially the real estate sector? Is that of interest in the private credit world?
So, go ahead.
Well, real estate is going to go through a massive workout. You know, I mean, most properties have debt on them. Any debt that was put on a property in the last 12 years is going to have to be refinanced at a higher rate. A lot of properties don't support that out of their own cash flow. And a lot of real estate owners don't actually have a lot of money in the bank to pay down debt or to somehow take care. And so I think we're going to really see a wave of workouts in the real estate world. And that's going to detract from a lot of interest in new things. You know, I think the workouts are going to be the thing. I'll let you talk about energy if you'd like.
Well, I don't, you know, we don't really do a lot of energy because we don't like the volatility in the commodity price, and you really can't control it. And there's political factors at work. You know, we certainly have exposure through some of the different investments. I mean, I will concur with what you said in real estate. In fact, I got a call from my OCIO last night. We're about to make an investment in a manager that we've used in the past who's doing a just, you know, a more distressed real estate fund, which we think looks really, really interesting. And we were going over allocations for that last night. So we are excited about that sector. But, you know, energy can often be very club deals, right? I liken it to, you know, like we don't do it in the fund that we're raising, because by the time it gets to our desk, guys who know a lot more about it have probably picked over it. You know, I liken it to, I dabble personally investing a little bit in Broadway, right? And about a year ago, something came across my desk. It was the cast album for The Music Man with Hugh Jackman. And I thought, if I'm seeing this, something is really wrong. Right. And sure enough, I made 3 or 4 phone calls and I was right. There was a lot of hair on the deal. So we passed, and we kind of feel the same way about energy. It's just too hard.
And I would add to that, the energy transition creates incredible uncertainty. You know, most people who tried to invest in renewables have not had great returns. Yet investing in conventional energy seems like it's both risky, and if you work for a not-for-profit, it may seem like it's violating your principles or your values.
Right.
And so I think a lot of people are just pulling away from energy and saying, it's too complicated. Let's
not socially responsible.
Right. Which is going to leave it to the people who don't care. But it is very tricky right now.
Yeah.
Very tough. So Mauro, do you see any new exciting opportunities outside of the EU, or is that mostly where you spend your time and your investments?
Well, the only thing that we are looking outside the EU, even if it is pretty complex, is about mining. Because with mining, you just control one main variable. That mining, I mean crypto mining, clearly. You just control one main variable, that is the cost of electricity. So we go back to the energy sector somehow. Now, very, very low cost of electricity, you can find them in the STAN countries. That means Kazakhstan, Kyrgyzstan, Tajikistan, and so on. Clearly, this is very good from the cost point of view, but it's going to open other type of problem. As for example, they are very far, the government sometimes is not very stable, the geopolitical situation is not the best for this type of investment. So actually we are looking at a mining place in Estonia. Crypto mining investment can make from 30% till 100% per year. And with 30%, you can look at Bitcoin. That is clearly in the crypto sector, is the stable one, is the most stable and also the less risky. Clearly, we are already talking about a very, very risky asset class. But as I said, the mining investment for us is interesting because we would be able, with the current price, we would be able to recover the investment between 6 and 8 months. So we have a very short payback period. The lifetime of the machine can be around 3-4 years. So we have a lot of time. And once we pass the initial 6-8 months, in case that the Bitcoin price is going down, we can even decide to switch off the ASICs that are the mining machine. So that would be something that we are looking at. And the idea would always be to tokenize the investment in mining. So to create a token that is representing a contract, that is representing a fraction of the ownership on that cash flows. So we are actually doing a discount cash flow of that investment. That could be real estate, that could be energy, or in this case, it could be crypto mining. Clearly, they would have different type of IRR, so the discount rate would be different. But would be very interesting to create a product of this type because setting up this type of investment is not easy. So we could add value once we will be able to create the entire chain and to resell them to the market.
Great, thank you. So for private credit here in the United States, is there any regulatory issues or monetary policy or political issues that you feel might change your investment thesis over the next 12 months?
Well, the biggest regulatory issue is continued pressure on the banks to raise capital, and essentially that means make fewer loans. So I think private credit really is here to stay. And I think the issue is more inside that market, figuring out how much, the relative value and returns from the different parts of the capital stack. And also, if you're evaluating a manager, do you look for the highest return, or do you say, well, they were taking the most risk in the last few years and that worked because it was a great period? Or do you look for, a different way of deciding who to pick? But I think the runway right now is very positive.
I agree with that. I think you make a good point, and I'm going to change the question just a little bit. But
Sure.
The most important thing when you're looking at any one of these investments is your due diligence process. And I think you don't necessarily pick the person who's been taking the most risk. I think you want to take someone who's balanced and has good deal flow and access to opportunities. But people always ask me, like, what are your tenets when you're looking at a manager, right? And the first thing I always say is, if you don't understand it, keep going. Because the best thing that a mentor of mine ever told me was, it's much more important to miss a good investment than get a bad one. Because it's a lot harder to crawl out of the mistakes, right? You may regret not having made the good investment. We certainly regretted back in the day not investing with John Paulson, but our view was he had been a B- manager in the merger arb space at best, and it was a binary trade, and we weren't in the business of investing in binary trades. We were wrong, but so it was a little painful, but much better that than getting something that's bad or getting and I think if I'm new to investing in private credit, right, I probably want a clean book. Right, I would rather invest in a guy who's launching a new fund or fund 2 or fund 3, so I'm not getting the legacy problems that probably I'm fairly certain exist, unless I have a a lot of confidence in where those loans are already marked, and a lot of confidence in that manager's ability to work them out.
So how do you guys measure the size of the pullback, the capacity of the strategy of these credit strategies? I mean, there's a big difference in lending credit at 1% versus 7%, or if it's, you know, hard money sort of, or gap financing or mezz lending at 14%, and also the role that Warren's playing on this. I mean, you say there's a big bank pullback. I think everybody agrees on that, right? But how do you?
Well, these companies just can't
Banks
get
are making
financing
loans.
from these regional banks.
Banks we're making loans at 3%, and now if they go to a private lender, it's at 10 to 15%. So I mean, you know, how do you measure that?
But the banks are even worse than the private lenders we're hearing.
Well, I think the benefit of having money to invest today is when someone comes to you and the coverage ratio at, let's say, 10%, just as a round number, is not good enough, you say, sorry, no interest, and they eventually get worked out. So, you know, I think the people who are making new loans today are able to find borrowers who are able to support the current level of interest. And the thing is, with the old loans, they, as I think Suzanne said, they're going to roll off over time. They're not all coming due tomorrow or next year. And so I think a lot of companies have to figure out, how do we manage through this problem, maybe raise equity, find some other way to deal with the fact that they simply can't pay a higher interest rate. Just one other point on that, I think the structures for private credit are important. I think drawdown structures are much better than hedge fund structures here, because when money comes in and goes out of a fund, you're essentially valuing every asset in the portfolio. And the valuations for these investments is not clear cut. So rather than subject yourself to that, I think going into a drawdown structure, you raise money, you invest it, you hold it, and when the loans mature, you give it back, is a better format for that kind of investment.
100%. I mean, it's interesting. I just met with a manager the other day who did have an evergreen structure, but it wasn't a hedge fund. It's an evergreen structure where money you invest, they draw it down into the evergreen structure. The new money coming in only invests in the new deals. So it's not diluting people who were there before. There's a 2-year investment period. As the old deals roll off, he gives the money back, and it works that way. So I do think that works, but I think a hedge fund structure where people can redeem on a quarterly, semi-annually, or annual basis is a disaster waiting to happen, because you know what's going to happen? When the shit hits the fan, the manager's just going to gate, and everybody's going to be in the same position, because you can't properly value those loans, and they're not tradable really at all.
And if you're wondering whether or not that's true, look at that Blackstone real estate fund, where they had a huge level of redemptions beyond what they could even accommodate.
Suzanne and Brian, I've been on the inside as a private credit lender, and I've seen how the sausage is made. So it scares me as an LP. But you point out a big variable, right? And that's valuation. Have you, as an external LP, come up with solutions to address that, so that you're not just relying on the money manager, or you're not relying on a third-party valuation organization that's in the hip pocket of the money manager?
Hard.
You know, honestly, if you think about private credit and private equity, you go back to the early days, they had a whole different valuation structure. It was called lower of cost or market, or LOCOM.
Right.
And the idea was, you made a private investment, you just kept it at what you paid for it, unless something went wrong. And the accountants have actually moved in and said, no, everybody has to value everything all the time.
Right.
So my argument would be, don't pay that much attention to those numbers, because they have to put a valuation on it, or the accountants. What you want to know is, do the loans get paid off? And do I get my money back? And when they have problems, what do they do? And so the whole valuation thing in private equity, I think, is overplayed.
Yeah, I agree with that. And it's interesting, this manager, again, that I was talking to the other day, they were talking about how they meet with investors, and investors are saying, well, what is your model for where you lend? What coverage ratio do you make? They're like, we don't think about it that way. We want to be covered. So it's going to be different for company A than it is for company B, than it is for company C. And as long as I'm covered, I don't care. So I think it's really underwriting. The horse is private credit, right? And the jockey is the person who's picking the horse. So you really have to underwrite that jockey.
Well, one of the things that I've seen, so we presented yesterday, we do inventory funding, right? And one of the things that like there's this constant tension between like you increase the amount of structure around a deal, right? And then that necessarily, it increases the security, but it also makes the deal less palatable, right? For the market. And what we've seen is that like the highly competitive businesses, the best businesses still have options in market today. We see some ridiculous rates going out to some of these companies, right? So how do you guys think about, as a manager, right? Like the structure around a deal that can lead to negative select versus a more flexible, like vehicle that then is trying to select for higher quality and lower risk?
Well, I think it's the point I just made, right? Company A is different than company B is different than company C, and it's having a comfort level with what your coverage is. If you think it's a good company and you think and it's cheaper than you're willing to lend, I don't necessarily think that that's negative selection. It's just you're in a different business.
Right.
You know, it's a risk tolerance issue versus.
Yeah, and I give a little bit of a different answer. I'd call that specialty finance. And I think specialty finance is
That's true,
actually
too.
quite interesting because presumably the lenders have developed a strong expertise in a very narrow space, and they can make loans that the typical investor could not really underwrite. So we love actually specialty finance. I haven't seen that kind of inventory, but even drug royalties is a good example, or aircraft finance. And so I think but again, you really are evaluating the manager more than the underlying, and just are they good at doing this?
Marty, I think you had a question. You were going to jump in.
Was that
Let's go.
Are you guys more focused on managers who are lending out at a floating rate or fixed rate, or that's indifferent?
I'm agnostic.
Yeah, I think the senior credit these days seems to be floating rate, and that's what, most of the loans are. And so I think you have to accept that that's what they're going to be. And it's certainly been valuable in the last few years. And, but you have to make sure that the borrowers are hedging their interest rate risk, which I think sometimes they're contractually required to do.
Right.
But that's the one risk with floating rate debt.
Historically, they always been floating rate.
Well, no, if you go back to the 80s, the banks had floating rate. They called it the prime rate once upon a time. and it's migrated from there.
Yeah.
It's bad.
Marty's.
Well, what about duration? Are you seeing any very favorable durations, and what role does duration play in your picking a fund in the credit space?
Well, the longer you go out, the more you're adding interest rate risk to your mix. And certainly in below investment grade land, 10 years is about as far as you go, and probably 7 to 10. For investment grade, I think the driver is what maturity do you want, as opposed to the credit aspect of it.
Yeah, I mean, look, I've been looking at some of these private credit funds, and the 2 to 3 year investment period is kind of, I think, the right place to be, to get the money out. Because you don't want the one thing you don't want is to pressure people to put money to work when they're not seeing the right opportunities, right? You want to give people enough runway to pick and choose the best deals. I remember years ago, I was involved with a fund and we were sitting on a lot of cash, and one of our clients, because we just didn't see the opportunity, we were waiting and we wanted to have powder dry, and we had a big investor come to us and say, "You're sitting on too much cash." And we said, "Okay, here, take $50 million back. We don't care. You can give it back to us later," because we were a hedge fund structure. We gave the money back. We had a great year the following year, and they called us up pissed off. So you can't win for losing.
Right.
So I think it's like, if you want to be a timer of the market, you should probably be like not investing with managers and manage it yourself. I think when you hire a manager, you have to trust them and trust their judgment, again, underwriting the jockey, to put the money out when it's the best time to put the money out. And that's why for private credit, these drawdown structures make so much more sense.
And if only the biggest problem was people not investing fast enough.
Right, exactly.
Right.
Exactly. But you do want to give people runway so that people don't feel pressured to put money out for the sake of putting money out.
So do you primarily invest into the fund manager or direct investments into the company, or a combination of both?
in my family office, we're investing with managers. In the firm that I work for, we invest in the debt of the company. But as a family office, we don't feel we have the expertise to be able to follow multiple deals. It's obviously not what I'm doing full time. And I would rather pick the best jockey who's only, I mean, I remember my dad was a trader on Wall Street. And he retired a long time ago, sadly for me, or I would be an heiress instead of, he retired in August of 1982, as many people, friends of his over the years have reminded me, he was the nadir of the bear market, but he had a great life. But he, I remember being, having just graduated from college, and I'm going to date myself, I was in the training program at Drexel Burnham. Wow. And I was the very last one, actually. Being home over the weekend, and my homework assignment was to write a research report on Northwest Airlines. And this is before the Chechis took it over. And I'm sitting by my parents' pool, and I'm like, Dad, and I had no money, right? And I'm like, Dad, you have to buy this stock. It's going to get taken over. I'm convinced you've got to buy this stock. My father said, I don't buy stocks. I said, what are you talking about? We're sitting here because all you've done your whole life is buy stocks. He said, I'm retired. I'm not sitting in front of a screen. I might be on a mountain skiing. I might be on a stream fishing. Something changes and I'm not paying attention. And that's the end of that. I'm going to hire guys who are sitting in front of their screen all day long. That's all they're doing. That's all they're breathing, sleeping. It's the same thing about if you're getting on an airplane. I don't want to fly with a, and by the way, my apologies to anyone who's an amateur pilot, but I don't want to fly with anyone who's an amateur pilot, because a pilot of my late father said to me once, the guy who's the amateur pilot just came out of a meeting where some banker is trying to screw him over and he's got that in his brain. He said, all I do as a pilot, this is how I make my living. So all I'm focused on is flying this plane and making sure you're safe, right? It's the same concept. And just to correlate to that, my stepmother had a little bit of her own money that my father had invested. She wasn't big enough to be in funds and different things. And guess what? He forgot she owned Bear Stearns. Forgot. It wasn't big enough to move the needle in the grander scheme of things. But, if you want professionals who are focused. So if you're not doing it all the time and focused on it, you're better off. I mean, people talk about fees in the alternative investment business. I'm sure you've too. Like, don't count the manager's money, count your own. I guarantee you that anyone in this room, if they could get into Renaissance Medallion and pay $5 and $50, we'd all pay it and be very happy, right? So if you're getting the net return that you're comfortable with, pay the guy to do it for you. It's why I use an outsourced CIO, because I'm not going to see as much deal flow. I'm not going to be as on top of it in terms of following it and doing the due diligence all the time that needs to be done. And I'm going to miss something. So.
Well,
Mauro, do you have anything to add from structures or what you look to create or invest in yourself?
Well, we are not, at least I'm not really following any private debt investment. So it's not something that I can add. At least I would say that clearly it's a particular moment for interest rate, and it's something that we are very careful. We prefer to invest with a low level of risk. Also, when we enter in real estate deals, we do not really make an investment if before we are not able to sell at least 50% of the units as pre-sale, so on papers. That is what we have done in Courmayeur. It's this very beautiful location in the northwest of Italy. We are looking at another project that will be pretty big. It will be in Cortina, where there will be the Olympic Games in 2026. It's around a 50 million project. In that case, clearly we are planning to sell the units also internationally, because we believe it will catch up the attention of many people around the world. But as I said, we have this strategy. We usually sign an LOI with the owner. It's usually or a 6 months or a 12 months LOI. We make a small deposit if needed, and at that point we create the project. So we have architects, engineers, and so on. We create a rendering. We are also starting to use augmented reality and virtual reality to create very beautiful rendering to show to the clients, because clearly the clients they want to be able to see the units that will be built, but they just see the building as it is in that moment, so before the renovation. At that point, we pre-sale all the units, we take the deposits, and if we get to at least 50%, that it means that we are able at least to cover almost all the costs. Then we start to implement, we put the equity, we buy the building, and we start the renovation. I would say that if you are able to pick up the right place, the right location, it's a very, very beautiful strategy, because the amount of equity that you are going to put is very, very small, sometimes even null, and you already have the business plan completed. At that point, we may even look to sell the entire operation to a general contractor that will take the project and will complete everything, delivering all the units. This is clearly a strategy that we would like to replicate again in Cortina d'Ampezzo. That is this place where we will have the Olympic Games. So at this time, we are we pay a lot of attention. I would say we are a little bit risk adverse in that sense, with everything that is listed, with everything that is on the public market, as we believe that there will be recession in the next years. And this is why we are trying to look at something that is alternative, that is decorrelated with the public market.
Great, thank you. So to close this out, do you want to share any phenomenal next investments that we should all write down?
You've got about 10 minutes.
Thank you for going first.
Oh, ladies first. Well, listen, I mean, shameless plug for what I'm doing, but I think that the new fund that we're raising in the lower middle market, event-driven space, is obviously a very attractive place to be based on what we're seeing. And frankly, the folks I teamed up with, there's something to be said for gray hair in the restructuring business. They've been doing this for north of 35 years, and they've worked together for that long. So you don't have to worry about the fact that it's a new fund. It's not a new team, right? If they were going to get divorced, it would have happened already. So I'm happy to talk to anybody about what we're doing there. And I think I've already kind of covered it. I mean, still very enthusiastic about healthcare, obviously enthusiastic about, workouts in the real estate market. I mean, it's commercial real estate's obvious, right? And again, you're going to really have to underwrite the jockey. And I think the other thing I would just caution everyone, and this is something that people, I think, have gotten maybe a little bit lulled to sleep with where rates have been, right? Leverage is an issue, right? Leverage. I remember years ago after Long-Term Capital giving a keynote speech at a conference in Hong Kong, and everyone's like, "Oh, hedge funds are bad." And I was like, well, why are hedge funds bad, right? It's a structure, not a strategy. And I think people forget that. If a hedge fund is long short technology, for example, and the manager therefore has more arrows in their quiver than the guy running the technology fund at Fidelity, a long-only mutual fund, for a lot of reasons. The long-only mutual fund is mandated to be fully invested, can't hold cash, right? So the best that guy can do is rotate out of the way of sectors that are going to do worse than other sectors, right? The long-short guy can be short, he can hold cash. And if he's not, and an apples to apples basis, if they're not using leverage, it's not any more risky, in my opinion. I mean, you could argue that shorting is more risky than holding longs, but if you pick the right jockey. So I would be looking through managers' portfolios and really understanding what kind of leverage they employ or are looking to employ. In the fund that we're raising, we use no leverage because we feel like the businesses we're investing in are levered enough. So we're not using leverage to amp returns. And that's another important thing when you're looking at net returns. Is it net, or have those returns been amped with leverage? I mean, a lot of fixed income managers, rode on the carry trade, and that works until it doesn't work, and then it's really ugly, right? So, I would caution, looking at leverage levels in anything that you invest in.
So to just follow on one of the things you said, how do you think the workouts are going to be different for the real estate market, commercial real estate market versus companies, and what the levers they can pull, maybe what's changed over these past couple of years with higher interest rates?
Well, I'll let Brian, I mean, I think that the workouts in commercial real estate are really gonna have to be with very specialized managers or real estate operators that are buying the entire project, right? People have asked us, because we're good at doing these restructurings and workouts, if we get involved in that area, and we were like, no, because we can't buy a portion of a building necessarily. You really have to do it right, in our opinion, buy the whole project and take control of it. And those are gonna require big pools of capital. So you need, you either need somebody who's doing one-offs, right? And then they really better be good underwriters, or you need the really behemoth managers like an Oak Tree that, have the ability to buy multiple large projects. And that's.
Yeah, well, I think in real estate as well, there are fewer levers to pull to fix a building. Rents are what they are. And if the owner doesn't have money to put into the building, the lender is going to end up owning it. And either that, or saying, okay, you can have no interest for the foreseeable future, or possibly selling the loan to somebody else at a loss. That's about it in real estate. Companies have a lot more levers, and there are a lot more, a small amount of capital can fix a balance sheet. And there are people out there who are willing to make that investment.
Yeah, and I do, and I totally agree with that. And I do think commercial real estate is really location is going to be it's always been important. It's going to be even more important because the working model has changed. Companies, organizations don't need as much real estate. We've gone to this, for the most part, hybrid model. We're at 54th and 5th. I don't see anybody when I walk in and out of the lobby. And I only go in 2 days a week, but I mean, I'm kidding. And our building is owned by a German family, and they seemingly have enough money that they just don't care if they've got vacancies and whatever. But I don't see that changing anytime really soon. I mean, I think it's different in Dallas and Miami, where you're seeing this influx of people moving for other reasons. But I think, New York, Chicago, LA, I think there's problems. And I think they're going to be around for a while.
A couple of weeks ago, I met someone whose specialty is converting office buildings into residential buildings, because that's not easy to do. And he's saying, well, I've been doing this for 20 years, and I typically had one project a year, and now I've got 10. And I'm going to raise my first fund because I just did one at a time. And, and I think that they're being inundated because so many office buildings really are not going to be competitive as office buildings anymore. Less demand for space, Class B space, low rents, it just doesn't work.
But I think that's right. And in fact, the building right across the street from our office building has been converted to residential. But, if I'm moving to Manhattan, do I want to live at 54th and 5th?
Right. Well, the basis for that building is going to be a lot less than it was when the
100%. I mean, I was at a building the other day on 57th and 6th that a friend of my daughter's, they moved in during COVID, and they moved there only because their office is a block away, and the husband and wife run a business together, and she wanted to be able to come back and forth. The building's empty. They said, we moved in during COVID. We bought one of the first units, the old Steinway building.
That's the Steinway building, yeah.
And they said, we're the only people here with kids. The apartments that are owned are all pied-à-terres, and they're not all sold. And and it's amazing because they've got a pool and a spa, and their kids are just running, it's like having 2 houses plus their apartment, a golf simulator, and all this stuff.
Sounds amazing.
It's amazing. My daughter was like, Mommy,
What was the address?
our apartment sucks.
It's over the Steinway showroom.
It's 7th and 6th. It goes between 57th and 58th.
Building that looks almost like you wouldn't want to live near the top.
But there's 2 floors. There's a floor with a pool, a gym, party space, all this kind of stuff. And then there's another floor with padel, which is apparently a fancy form of paddleball, but it's called padel, and a golf simulator and all this other stuff. My daughter was like, Mommy, you suck. Like, we live in a horrible place. I live at 82nd and 5th. It's not so bad.
I actually have a question for Mario. What type of cryptocurrency are you currently mining, and where are these mining operations? Mauro?
So there is, I would say the rising star right now is a cryptocurrency that is called Caspa. Caspa right now has some really amazing returns. You are able to have a payback in 3 months. And then you have the remaining 4 year and 9 months of profit, actually. The problem is that clearly Caspa is a pretty new cryptocurrency. The hash rate is going up pretty quick. And yeah, you do not know for how long it will remain like that. But right now, I would say it's really the rising star. I don't think that it has the best return that you can have in mining. Let's say that in case we will create financial product on this asset class, most of the investment will be concentrated on the Bitcoin. Because we have run some analysis in the past, we have seen that it's a pretty robust strategy, as you need the price of Bitcoin to go below 20K, even with a sensitivity on the difficulty of mining. So we will concentrate on the Bitcoin mining. Even if I believe that the future is proof of stake and not proof of work. For the mining facilities, we are looking at Eastern Europe because clearly all the countries that I was listing before, they take, they have a very, very good cost of energy, but they have other risk that you need to balance at the end of the day. So Estonia, Lithuania are countries that are in the European Union, and it's a country where you can be sure about your rights, you can work with lawyers, they are stable countries. Even if maybe you pay the electricity at 0.01 more than in the other countries. So the cost of electricity is for us for around 1 megawatt will be around 0.006, 0.007. That is pretty good for us.
So, so a couple of questions. So you talk about private credit, but how do you, the data around private credit, how do you understand that data? Like, I mean, it's private, so how do you know the data that you have is good, full, you know, so that they're able to review the kind of investments that are being made?
Well, I think you can look at a lender's track record, you can look at their portfolio, you can see what they've been doing and how they underwrite. And, you know, I mean, in a way, I don't think you need to know the universe as much as you need to know what this particular manager does and how they do it and what their career experience is.
Which brings up my follow-up question, which is, what are your thoughts on policy? Because a lot of the issues that we have are policy driven, either by the Fed or by the government, right? I mean, we have a real estate crisis because of policy, primarily. Right? We've built too many commercial buildings, not enough houses, right? And so, where do you guys think about, you know, does policy sometimes say there has to be an opportunity here when you think about this stuff, or what? Can you talk about that?
Well, I think we haven't built enough houses, right? It depends on where, right? You can buy a house in Detroit, right, at a pretty reasonable amount. There's a lot of them.
They're fixer-uppers.
I mean, there's a lot of them. So it kind of depends on where. I mean, you know, I don't know that policy has necessarily driven to some extent it has for sure, but it's not 100% of the culprit with the commercial real estate crisis, right? We had COVID and everybody learned that you didn't have to be in an office to work successfully. And that was a game changer. You know, it's like, you know, I don't know, when I was growing up, we were watching the Jetsons, right? Who thought that was really going to happen, but it really happened, right? So, you know, that has changed. I don't think it's ever going to change back. So I think there has to be it's the wrong word, but like a right sizing of the expectations for the uses of these buildings. And, you know, as you pointed out, they're doing more housing in some of these commercial buildings. I mean, I think you're even seeing you know, in non-urban areas, warehouses and things being turned into lofts and housing for people. So I don't, you know.
Well, COVID shutdown is probably the greatest example of policy miscue ever. Right? I mean, it changed the landscape.
Yeah, but was that, you know, I guess that was I don't,
Just, I
I guess I
mean,
don't
it's,
look
I
at it
mean,
as
I'm
much
saying
of
it's
policy
super
as some
odd.
people.
It changed the landscape and then you have to react to it.
You know, some areas like affordable housing, there are people who make money investing in affordable housing, but they know all about government subsidies. They are
Sure.
experts
They have
Government
dedicated
subsidies.
staff to it.
and they
Correct.
know exactly how to do that. A lot of investors would say, you know, I prefer to not like do what the government is subsidizing. I'd like to just go into something that stands on its own.
Certainly at risk, right?
Well, right, that could
More
change.
Well,
real,
it can
more
change,
real
and I-
estate billionaires have come out of affordable housing than any other part of real estate.
But, and I think your point is well taken. You really have to have somebody who knows how to work that system and really has the inside track, because look at what's going on in New York. I mean, this is a different issue in the migrant crisis, right? Mayor Adams totally miscalculated the fact that he was going to get help from the federal government. Why is he not getting help? Because Biden knows New York's going to vote blue anyway. So he doesn't care, right?
Wow.
He's going to give the help to places where he needs the votes. And so now as New Yorkers, we're being stuck dealing with the migrant crisis because
more policy.
Adams, it is policy, but I'm
Is
saying
there
Adams
investment
didn't understand how to
thesis
work the
around that?
system.
My question is there investment thesis around some of these policies? I mean, it seems like that would drive opportunity.
You'd have to trust politicians, which I
Yeah,
don't.
that's right. It's better to just
I
go.
just-
I'm talking about that policy, right? I mean,
Yeah, but unfortunately, like, I don't know, my feeling, and there's probably people a lot smarter than I am and a lot more sophisticated than I am. It's not something I understand or I think is predictable. I mean, again, you know, early on in investing, right, somebody said, this is the only business where what the SEC makes you put on the front of the book, past performance is not a good indicator of future results, is true, right? If you make good widgets yesterday, unless your plant breaks, you make good widgets tomorrow. So how do you decide if an investor is lucky or truly skilled? Do they have a definable, repeatable process? How many decisions have they made? If you've got a guy who's been right 8 out of 10 times on 10 decisions, that's not as compelling as someone who's been right 80 out of 100. And the problem is policy can just change on a dime.
I'm gonna give you a good
You
example
can't
of a new
predict that.
policy that's coming out, that's really gonna change the real estate landscape. This Airbnb policy that's coming out of New York City, it's filtrating through the country right now. Every blue city is adopting. I was just in Richmond, Virginia, small city of 130,000 people, they've adopted it. Too many wealthy people looked at rentals and houses as short-term rentals. And now they're getting rid of all of it, and they're expecting that less than 3% of Airbnbs will be sustainable and return repayment going forward. That's gonna hit every blue city. That, to me, that means some real estate will come out. You know, there's gonna be opportunity to be an opportunistic buyer of that real estate. People are gonna be in the market saying, if I can't rent this stuff, I don't want it. I've got 10, Airbnbs in my portfolio. I gotta get rid of it, right? I don't know.
Well, and that's another reason that energy is a kind of a stay away for a lot of people, because the government is so involved in that. And they're subsidizing one thing today,
To change.
but that
There
could
you go.
change. And in the meantime, they're discouraging something else and that could change. And so I think a lot of people just say, I'm gonna just have to look elsewhere.
I think but I think, Meredith, you kind of helped make my point, right? Who thought that Airbnb legislation was gonna come down? And
It's amazing.
you understood it coming down in New York City, perhaps, because everybody lives on top of each other. But who would have thought Richmond, Virginia would have
It's gonna
cared?
hit every Democrat.
I
run city.
understand, but I'm saying that would have been a very hard thing to predict. And so,
So why
There's a
did
housing
Democrats-
shortage.
Why did Democrats fight this Airbnb? I don't understand, why?
Because it makes housing expensive.
But does it make housing expensive, or I have a condo and I really don't want renters to keep coming in next door to me all the time, because you get some good ones, you got some obnoxious ones.
It's also a quality of life issue, right?
It really is.
but one would argue that the quality of life issues should be governed by your condo association, not the federal government or the state government. You know, I don't know. You know, I'm a person who likes less government versus more. So, you know, my co-op has rules, right? We don't let certain people, I mean, I'm not on the board, so I don't, but you know, there's metrics you have to meet in terms of finances, and then people get turned down for reasons that are not known, even to me, but
I don't
you
think
know-
most associations saw the Airbnb coming as a disruptor when the. rules
I
were
understand,
written, so that
but
was
you can
different.
change, but a co-op
Can change.
or a condo association can change their
Yeah,
rules
they change the
for their
rules
own little
annually,
community.
sure.
That, I think it should be dealt with on,
Right.
a case-by-case basis by the people who live there.
Question on
If
energy.
you have 10 people, sorry, if you have 10
Sorry,
people who bought in that building with the idea that you're all in the same boat, you all wanna do Airbnbs and then use it when you wanna use it. If you've got mostly a property where people are living there full-time or then it's different. And then I think that, I don't think that should be legislated by the government. That's just
Last question.
one man's opinion.
On the, you may have said energy is risky, but where are you investing within the energy space? It seems like power purchase agreements are less risky than investing into a solar farm or, wind turbine farm when it's greenfield, but you have contracts to build, but even getting those parts in, you saw what happened with the 301 trade tariffs. I can see where that's an issue, but further down the road on the power purchase agreements, is that really that big of a risky investment?
Well, if they're not very risky, the return may not be that high. In other words, if you've got investment grade counterparties, it looks a lot like a bond structured as a contract. And so those returns may be better than owning a bond, but probably not that much better.
Oh, I was actually referring to, okay, I'll say.
It's not something I know really enough about to comment.
We do arbitrage, on a tribal basis, we do arbitrage between the US and Canada or US and Mexico. So there's generation differentiators from country to country, which take care of the arbitrage, does pay much better than the typical bond, but I do see your point for domestic relations.
Fantastic. Great job, Mike.